Think so. Been
All
a while.
right. Fucking forgot how to use this. I guess we should cut that part out. But let's start with what is it? Take four? Another conversation between Brad Laddusaw and Corey Siegel, SNL Capital Group. Been a whirlwind of a year since the last time we've done this. I'm trying to think back when the last time we did take three, but it's been a few months. Let's just say
It came out a little hot and heavy. I think it was the end of the summer or something, and then life happened.
life happened. Business has been ebbing and flowing, which is just the nature of the beast that we're in. And, sometimes you got to put your head down and just keep cranking because ultimately that's what we do. That's what we do. But excited to get back on it. I mean, I got to tell you, not to say that I'm one that struggles with a little bit of FOMO, but I see all of your CMA podcasts and webinars, and I say, man, that guy looks good, sounds good. I'm glad he's my business partner out there on all those videos. And it's good to be back though. You always interesting to
I
see you
just
out
still
there.
can't. I still can't call them a podcast. But I mean, an interview is a podcast, I guess. So it's no, it's been good, and it's nice to interview different vendors in the space, and then jumped on Kevin Kim's Lender Lounge. Was it last month with Brock over at Talomar? So that was a good conversation we had. Talked about CMA, and then just the California private lending industry in general and the market. Just fun going down some rabbit holes.
Well, I mean, I got to tell you, there always seems to be something that is coming up on the legislation and compliance side. So as the president of CMA, I know you have a lot of built-in topics that you are able to kind of work in to the videos because that's an evolving side of the business, one that we've talked about it on a past discussion that's pretty invaluable to what we're doing. But ultimately, I think talking shop casually with you and me is always fun as well, and try to keep it light. And I'm excited to hear what you jotted down on your new e-journal to try and take the cake for the surprise questions today.
Here, here it is.
There it is. Look at that.
12/9/2025.
My goodness. I would say, I mean, I don't have good handwriting, but that looked like Logan might have wrote that before he split from the office a little bit earlier today.
No, I write like a doctor without the degrees. So
Oh man. So it's
so
been
so
fun,
we got some
man.
updates on our end.
Yeah.
As we over the course of the year, there's certain things that we would just refer out. But you
Yeah.
jumped into some licensing. Would you mind updating the group on what you've been doing the last month and a half and
Yeah.
what that means for S&O Capital Group and some of our real estate agent and broker clients heading into 2026?
Absolutely. I mean, we're really, really excited about being able to do this. And I don't know if you saw the emails flying through right before we jumped on this, but it looks like we are just one step away from being active. The SNL Capital Group MLS license is good. The sponsorship is approved. So now we're just waiting on the final NMLS license for me to be tied to the SNL Capital Group license, with the plant and real motivation and confidence that we can get out there and do consumer bridge loans. I think as we get into markets, it's interesting when the market is super hot, a consumer bridge loan could be a great product. When the market is cooling off a little bit or getting back to a more traditional days on market when you're selling your home, that's going to be even more of a really strong option to offer to our real estate agent partners and referral resources. And we're really, really excited about being able to do that. I think a consumer bridge loan, plain vanilla aspect of it is client who has a property that they live in wants to sell that property and buy a new one, but may not want to list and sell their primary right away, or they want to list and sell it, but it's just taking the normal now, what seems to be getting back to normal, 30, 45, 60 days to sell and dispose of their property. It's really hard, even in this market that's kind of softened a little bit, where buyers are having, I guess I wouldn't say it's a buyer's market, but they're just getting back to more traditional types of way to negotiate. So when you're writing
I
an
mean,
offer
some
with,
buyers are like, F you, this is what I want. And they're extremely picky, and as they should be. I mean, it's just they don't
yes,
have. I was looking at the numbers from the California Association of Realtors earlier today. I think in the peak buying frenzy, average days on market was like 7 days. Insane. Right
Not,
now for
not normal.
California, it's around 32. So it's just reverting back to where it was like in 2015. And I think what you're touching on the consumer bridge, which is pretty bitchin' in itself, I mean, it's tough to sell a home and have a say, I need to buy my next home or get it under contract and have a buyer that's ready to rock and roll now. They may not have the liquidity to come in with a substantial down payment, but being able to tap that equity and that current primary for that acquisition, I think creates a lot of liquidity and some efficiencies in that buying process, especially for individuals that have just been in their home for a long time and have built up this equity. So I think it'll be good. And historically, we just send it out and hey,
Yeah.
get
It's
taken care of.
hilarious.
So
It's hilarious. And the amount that we've sent it out in the last 6 to 12 months, especially, has really been the motivating factor behind being able to roll out this type of program. We've got a lot of friends and associates in the industry that are been kind of nudging us politely, I guess, to kind of go in this direction. And I think it's something that we're really excited about. I think ultimately, when you're looking at the market where it is now, things have kind of shifted back towards buyers. They're able to negotiate seller concessions, credits, buy downs for their rates, but we're not quite in is such a strong buyer's market that a seller is just going to say, yeah, I'm going to accept your offer and be contingent on you selling your property, however long that's going to take. And I don't know if we get into that type of market here in the next 6 to 12 months, but the Consumer Bridge program is going to be really, really invaluable for us to be able to help some folks who either want to downsize, maybe empty nesters and have a ton of equity in their home, got their primary, they want to buy something new, they've got a low mortgage on it, and we were talking to our, investor side of that over coffee a couple weeks ago. The other option too, from a real estate agent standpoint, that I think is something that I want to talk to the folks that we work with about is you could actually position yourself to, on the exiting property, maybe even just do some minor renovations to it, update the kitchen, update something that needs to be updated, mechanicals, electrical, plumbing, whatever the main glaring issues are, to then list the property and sell it would, I think, be just such a great return on your investment. So you're not necessarily having to write an offer that's contingent on you selling the property as the seller leaving some money on the table before you can move in to your new owner occupied property. So we're going to get some marketing material put together on that. And the license is, as active as it gets before it's actually active. And it's taken the NMLS. They're probably normal standard timelines. So I'm not trying to, talk smack on the NMLS, but we're just eager and chomping at the bit to try and get something moving, because I think it's going to be a program we're going to. I like to say we're adding something to our product line. And ever since you and I have been in this business, we really haven't done that. We've been very focused on what we do, which is great. And that business is thriving right now, which is amazing. But at the same point in time, it's always exciting to be able to add something new so we can re-engage with our network and effectively just let them know that the option is there. I don't know if a lot of people know that that option is out there.
and especially not in Southern California. And we always say bridge is bridge. We stay in our lane. And this is not your, hey, we're going to be brokering this out for your 30-year fix, owner off type deal. I mean, this really has an asset based approach, underwriting approach, and the capital stack behind us for this type of bridge mirrors our current internal bridge for our investment properties. Just the disclosure timelines are different, just because we've got to follow that consumer aspect, and we'll probably do another video breaking down the structure of this as we get closer to the end of the year, and send it for educational purpose, especially to agents. But I mean, we just had a deal. Was it last month? We had an investor client of ours acquiring a fix and flip property. The seller needed to find their other home first. Once
Yes,
they found it, they just had to wait for financing to get in place, and this rolled like 2 or 3 months. And I'm not saying that we're going to be reaching out to these agents on the list side, but if that were to ever occur on a transaction, it's like, well, there's an option for that. And we have the prelim, so we could see how much equity it is, and really, it just comes down to math. Math is
that's it.
math, and
Yeah, that's the exciting part. I think
it's
equity is the key play there because, I mean, ultimately, people who have been in their homes for, I mean, anybody really, realistically, the target would be somebody who has purchased a property pre-COVID. And ultimately speaking on that front, like, that's a good boilerplate or starting point for us to be able to kind of roll this out. And as much as we're not trying to get involved in too many parts of the transaction, I think it's worth a call, right? It's worth a call because as with any side of your business, the bridge loan side, the fix and flip side, when you re-engage with people over a period of time, you have your priority list of contacts that you got to stay in front of. The worst thing that we can hear is a good thing, but it also is bad when you talk to somebody and they say to you, man, I really could have used you a couple of months ago. And it just cuts through. It's like a hot knife through butter. You're just melting over there. So ultimately, we want to make sure that we're going to get in front of people to do that. And I think we will. I'm excited about it. And I think it's going to be
Looking at you,
something.
I just thought of a phrase that my dad says when we golf, and it's not going to say it on this,
Oh,
but it
okay.
was yeah. Sorry.
Fair enough. Well, you'll have
I
to tell me later because your
wonder if I
dad
get
says
hit
a lot of your
get
dad
hit
says a lot
pause.
of funny things on the golf
Anyway,
course. I'm not sure if I can drill it down on that one. But yeah, so we're
has to
excited
do with
about
aunt and
that.
uncles. Yeah.
Yeah, right. Excited about that. But I mean, I think ultimately from our business side of things, I did a post on LinkedIn. Multifamily and commercial bridge loans have really been carrying the torch for us this last, I would say, 4.5 months or so of this year. And I think that is a good sign for what types of loans that we've been really trying to target over the last 24 to 36 months, really. And ultimately it just starts with like one call, right? That's the amazing thing about this business. And if you're prospecting or you're in this business and going through a little rut, like you just got to keep in the back of your mind that all it takes is one client, all it takes is one broker relationship really to turn things around and make things more fruitful. And it's not going to happen overnight. That you can't build Rome in a day or whatever the saying is. And I'm excited about that because I think as the residential side kind of cooled, right? And good product always sells. It just now it's taking a little bit longer to sell. We've been very fortunate to work with repeat borrowers for a majority of our careers, right? We tend to get in front of some quality people. They tend to work with us repeatedly. And unfortunately, if they're having, I guess, a little bit more difficulty disposing of properties or selling properties, they're not as liquid to purchase new ones. And so we got to have a little give and take. So I really love the channels that we're working right now. Um, and having those different types of avenues that we work on so that we can kind of plug and play as certain things slow up or get busier on different sides of our business. And that's really a testament to what you and I have been doing here over the last couple of years for sure.
Yeah, and I think it's a program that doesn't take rocket science to explain. It's like, here's what we need, here's the closing timeline, and let's let's rock and roll on that. Uh, amp amp to have that rolling, as are you, and it's I don't know, shit moves quick, and it's you touched on days on market and some rehab projects, kind of get not necessarily the project themselves getting delayed out, but I mean, what are some of the things our borrowers, rehabbers have been communicating to you? Because some of them source deals through wholesalers,
Right.
source them off market, whatever it may be. And those wholesalers are, and this is not a bag on wholesalers because this is not public information, but seller credits.
Yeah.
You go and pull comps on Redfin or MLS, whatever it may be, and you'll see, oh, we have 12 properties that sold between 675 and 725,000. But what those are not reflecting are seller credits. So
Right.
you may be looking at values on the front end, and you're not really going to see that till you go to sell your properties. And it's like maybe it's a one off on this property. But what are some of your clients seeing on when they go to get rid of the properties or sell
Well,
them, I should
I
say?
mean, that's a perfect example. I think ultimately, as you work your way through selling properties in what is considered a new type of market, right? I think ultimately the first couple quarters kind of really slowed down on the sense of what used to be versus what is now. And I'm not a predictor of the market. I'm not smart enough to even try to do that. I don't even pretend to, but I feel like we're in a pretty steady market with where we are right now. It could go either direction, right? I mean, policy and legislation and, different things that we don't control could push things in a good way, could push things in a bad way. But if all things are kind of level and steady, I kind of think we're in the market that we're in, and it's going to be pretty kind of leveled off here for a little bit of time. So now we have clients who, fortunately or unfortunately, got into the market around COVID or post COVID, and they haven't really experienced this. So I can't take credit for this. One of our great clients that I consider, friends, I'm friends with, and we have conversations more than really anybody that we work with pretty much daily. He brought this up to me because he was having a little bit of difficulty. He sold two properties, and some were okay, some were not, but kind of moved on to the next batch. And he said, "Hey man, I was having this kind of like oh shit moment where we're running comps, and unless we're looking at the details of the closing on the MLS information, you're finding listings on Redfin or Zillow or Trulia or however you want to look at your map and pull your after repair value comps. Those aren't reflecting the sales price, including commissions or on concessions, excuse me. So if you're giving a seller credit for 10 grand for a rate buy down or request for repairs on every single deal that pretty much every buyer is going to ask for now, not because they should, because they're finally in a position to be able to negotiate better. And that's really something that I think fix and flip investors need to factor into their deal. But like you said, if you're running ARV comps and you're seeing sold comps at 750 and there's four, five, six of them, you can pretty much guarantee that the actual net to the seller is less than that. I can't tell you the last time I talked to a client who's selling a property, because we always talk to them right when they're about to sell or when the payoff demand gets ordered and just kind of touch base with them. Just about every single transaction now is coming with some sort of seller concessions. And that's just a matter of fact. So all the more reason why when we run analysis for our clients, we're not necessarily looking at the highest after repaired value for this person to dispose of the property. So if we can be a little bit more conservative and therefore our clients are writing offers based on a little more conservative after repaired value, you would like to think, knock on wood, that you're just naturally building in spread for the things that were once not likely actually being inevitable of happening, meaning seller concessions. If you see six comps at 750, but you're running all of your numbers off of 725 or 730, that additional 20 to $25,000 could be kind of a buffer for those seller concessions. Now, you still need to hit your renovation budget and your timeline. You have to be pretty pertinent on those kind of things, but I don't think that what you're seeing on your traditional ways that retail investors are looking, whether it's Redfin, Zillow, Trulia, is a reflection of the actual closed sales price when you're talking about concessions. That's one huge thing right there, right? That we've talked about kind of ad nauseum here over the last month or two.
No, and then that's just a friendly reminder to where hey, if you're going on you finally got some properties off the books, got recapitalized, you're writing offers. Don't negotiate against yourself right now. Go hard. Like pick your line. Don't take it up. I mean, you can take it up if you want, but you make your money on the buy. You don't make it with the renovation. You don't make it with the gold toilet seats. You don't make it uh, necessarily on the sale. It's like you you can determine and bake some of that in on the acquisition.
Yeah.
When it was so crazy post COVID, it didn't matter really. You
No.
go overpay, over budget, and go an extended timeline 6 to 9 months, and you would get bailed out by the market. And if you needed had your loan was maturing and you needed to get recapitalized, there was a laundry list of lenders that, since you had such massive appreciation, would just give you a refi. Now you look at the numbers in California, let's just say it's traded flat the last 12 months or so. Slight pullback in some markets, but relatively flat. You have seller credits coming in on the back end. So if you're at a 75% ARV loan over budget, then to timeline, and values just held flat, you're not necessarily going to have that lender to bail you out for a refi to put some more money in your pocket to see that through. And I think we're starting to see some of that now.
Yeah. I mean, ultimately, we kind of see that too on the tail end, right? Because we get approached with quite a bit of refinance requests on loans that may be reaching maturity or are getting pretty close to maturity. And it was a pretty aggressive fix and flip loan. And for any given reason, right? That's the part that's really, I don't want to say it's frustrating, but it's one of those things where it comes down to now is a very important time to work with a lender that's going to look at your deal and see if it makes sense for you as the borrower. Not necessarily, is it only okay for the lender? And we've gotten into this, and I'm not saying this in a negative way, but the institutional money that is kind of flooded into this market, it's a lot of check the boxes, right? And those check boxes are very strong for the institutional money because their risk tolerance is a certain level, their pricing is a certain level, their loan to values are a certain level, but they really only need to see that first valuation, like an appraisal, or the first and second evaluation, an appraisal and a BPO show you a value that makes the loan work. That's fine and dandy and great. But if that only results in the loan getting approved, but doesn't necessarily take into account, like, what happens if your project goes a little bit longer? What happens on this six-figure renovation that you need permits for if those permits get delayed out 3 or 4 months? What happens in these scenarios where now at the end of your term, extensions are typically harder to get from those institutional capital providers? What happens when you get to the end of the term? You are down to the studs because it took 6 months for you to get those permits in place. Now you have a 75% loan to cost, 80% loan to cost, aggressive fix and flip loan on the front end, and your property value is probably not worth what you bought it for. Who's the takeout? It's not there. And so we're seeing those submissions come to us in a way that's like, hey, what can you guys do? And the sad reality of something like that is, well, if you guys have 6 figures to bring into the refi, we can help you. But if you don't, like, unfortunately, you want to go back to that lender and say, hey, I don't care how much this extension is going to cost. I just want to keep my loan in good standing and get it to the finish line. So working with a lender that's going to look at the deal and say, are you good in this best case scenario? Are you good in a more conservative space? I think is very important because a lot of lenders have taken a quantity over quality approach because volume is the king of the industry. How many loans can you do? How much money can you get out to the market? It just comes down in those situations of, do the numbers pencil for the loan that I'm trying to do, not for the borrower's healthiness and feasibility and all that kind of stuff. So we'll continue to shout that stuff from the rooftops, and people will think we're crazy. They probably think we're less crazy now than when we were doing it during COVID times, but hey, it all comes full circle one way or the other, right?
No, and it's even we get so I mean, just between last week and this week alone, I had I think 3 mid-construction deals refinance requests. Um, Loan is in a maturity default, but you pull that recorded NOD and it's like, well, unpaid principal balance is 3.5 on the deed of trust. The NOD is showing a balance of damn near 4 million. It's like that variance there is for months of unpaid interest. So it's
Yeah.
probably not a maturity default. May have started at that, but they ran out of extensions. Who knows? But then what gets tricky now because the market's traded flat, or even it's ground up construction, spec home. It's tricky to value, but you're coming to maturity or liquidity crunch. Your mid renovation winds blowing through the property. But the leverage on the front end was so high to where the refinance that requests are doing is to pay off the current loan, the accrued potentially default interest, and increase renovation budget. Now our new loan is above their basis in the property to where on paper, we're just cashing them out of the deal completely. So it's a push comes to shove down the road. And I don't care if that's 40% LTV or 75% LTV. Anytime your combined loan amount potentially cashes them out free and clear of that deal, you might be the last lender to do that, and I don't care if they got an 800 credit score, or poor credit score. It's these deals don't report to the bureaus. I'm just gonna get a new LLC.
Yeah.
I mean, I'm oversimplifying it, but and not everyone's that way, but at the end of the day, if that's why some borrowers want max leverage, it transfers the risk to the lender.
Well,
And if they
well, and
come
the
in
other
with
part,
more cash to close, some of that
yeah.
risk goes to the borrower.
S- Yeah, and like going off of what you just said about the max leverage, another conversation I have with people quite a bit, which again, we're navigating, I don't want to say a new market because it's kind of everything ebbs and flows, right? So we didn't just approach and come into this market, it kind of happened over time. But I have conversations with people who are like, I want higher leverage so I can do more deals, right? And I understand wanting to increase your volume. The problem that we've kind of see unfold over the last 12 months is what happens if 5 projects stall out at the sale instead of 2? You're kicking the can down the road. It's the same issue. Maybe you brought less money into the deal, but you're making 4 more mortgage payments. And those mortgage payments are naturally larger because you have to bring less money into those deals. And so to me, it's just we want everybody to grow. It's got to be a healthy growth. It's got to be a planned growth. And you can't sacrifice taking on deals in the way of sacrificing the quality of the deal just to do more deals. And if you're staying true to your numbers and you're trying to buy things at as much of a discount as you can, fantastic. Higher leverage, go for it. Good luck. I think it's kind of a good play in that situation. But just to go and get higher leverage so that you can do more deals, it's just a risky situation because we've had it happen. Clients have 4, 5, 6 loans out and projects are stalling out. Maybe they're even listed and they're having tough time selling them. Those are 4 or 5 mortgage payments you have to make for extended periods of time that you may not have been planning from the onset. And you didn't think about that when you purchased the first property. You were expecting the first one to be sold by the time you purchased the fourth property. And here you are 6 or 9 months down the road. So again, leverage when it's used kind of strategically is a very, very strong tool. Like it really, really is. But you can effectively kick that can down the road. We've just seen it happen. And not everything is what you see on Instagram. So your friendly real estate coach is
You don't
probably
say. You don't
y-
say.
your friendly real estate coach is probably a retired flipper turned Airbnb investor. I don't know, but we'll stop being negative.
I digress.
I digress. Is right.
No,
So
it's I don't know, and we've seen it over the years. When we underwrite files, we're looking at credit, background, schedule, real estate, and you have some borrowers that we would be chasing pretty hard, and we get the opportunity to do the deal, and then we look at the overall picture on paper, and it's effectively paycheck to paycheck,
yeah,
but they are have a very strong social media presence. I mean, they do great work, but they
yeah,
raise a lot of the money. They have very little of their own cash in the deal, and that is, I mean, when times are good, that works out. But I like to say, skin in the game drives the ship more so than credit.
yeah,
And right now, borrowers can still get, and some of them deserve it. I mean, they could get leverage and pricing that is not marketed. And if that's available for you, take it while it's there. And then there's some that, I don't know if you want to give them that leverage and that pricing, and they're taking it. But it's to say that it's how do I say this politely?
well,
To
don't.
say that the underwriting buckets are as divided as some lead you to believe, it's not, because when you have a shit ton of capital chasing too few deals, you're going to start making some exceptions to get it out. Maybe you're doing a loan to a borrower you otherwise would not at a slightly higher interest rate. That slightly higher interest rate today is still well below interest in 2013 and 2014 at
Time.
leverage that is probably 10 to 15 percentage points higher than that time. So it just kind of shows the risk return skew that's going on. And it doesn't necessarily make it bad loans for some of these larger lenders, just
Yeah.
because their risk tolerances are through the roof. And they're like, hey, we're expecting X amount of defaults on our total portfolio. So these are sliding into this tranche. And then we got this credit credit box, and these are going to go into this tranche. And here's the borrowers that we cannot lose at any cost. And those are, the A at the very top. And they get pricing and leverage that is not marketed and shouldn't be marketed. But it's like, and I don't know, no one's publicly traded, but I'm just curious on, all right, when that bottom tranche gets kind of filled, or the market shift, or something trades flat, or a model is off, what happens then? And I'm not saying lenders go away, but I do think there's going to be a rebalancing in pricing and leverage. I don't think lenders are getting wiped out as defaults increase, but I think pricing might need to tick up a little bit. And I wouldn't be surprised if leverage started ticking back. I mean, over the past year, it's been incremental. Last year was 90% loan to cost. Then you saw a 92.5% loan to cost. And I saw one 93.75% loan to cost. And I saw a 95. And then I recently saw a 97.5. And then I saw one yesterday for 100% of everything. I'm like, all right, we're just kind of tick, 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 ticking it up. What's next? 102.5? Like, pay their admin to do the deal? I don't know. I think we're hitting the ceiling here on leverage.
Yeah, no, I agree. I mean, I think there was a time in this space that leverage and pricing were kind of correlated. Higher leverage, higher pricing. We just haven't really seen that. And again, nothing again. Institutional could be a great bucket and tranche of money for real estate investors. They obviously are doing very, very well. So maybe we're in the
It's
minority.
a
Uh,
fascinating
uh,
facility.
it's
The leverage
amazing.
and
Yeah.
pricing and the efficiencies they have on their approval process are I think it's
And just
remarkable on
the sheer
how they're able
amount
to
of
get that
capital.
money out. Um,
Yeah, the sheer amount of capital that they can put out is amazing. And then you think to yourself, like, as you mentioned, you go on run comps today on properties that have sold. There are fewer houses that have sold in the last 3 to 6 months than if you did this a year ago. And so just naturally, the number of transactions are down. And so when you're looking at in a high volume fix and flip investors, like just the number of deals that everybody is doing, I think is down overall. And so that just opens up the tranches. What was once a program or pricing or leverage option that was only available to quote unquote experienced investors is now pretty much open to everybody. Now, here we sit today, and that could be a recipe for disaster. And what is disaster? All of these companies are big enough to absorb some losses. So it's all relative. Or it could be the smartest decision that anybody has ever made, right? Because in 6, 12, 24 months, the market's humming along. Then here we are again, egg on our face. Like we were talking to people about, hey, COVID, we don't know if prices are going to go up during COVID. Like you don't want to bank on it. So it could happen that way too. So what do we know? We just know in our gut that it just seems like the risk return profile on some of these transactions is skewed. And that's our personal belief. And we run our business to try and reflect that. And we're not putting out $100 million a month and selling it in tranches. So we're just in a different business model and a different risk appetite. And as an old friend of mine would once said, there's an ass for every seat. And that one has stuck with me because that is very, very true. We are sitting in one seat and those guys are sitting in a different seat. And it's all preference at that point in time.
Very true. I mean, pivoting here, going into end of year, into next year. We've talked about it for a number of years. I mean, I was on a webinar earlier this morning. I said that the biggest regret you and I had was not hiring someone like Kristen earlier on.
Yeah.
It kind of impeded on our growth. Um, Something that from a sales side of thing, what's something that we have had lacking, let's say the last year, year and a half, because we have months where we're cranking and
Yeah.
then slows down. And then when it slows down, our origination strategy's going again, and then it cranks up and slows down. But what do you feel we've been lacking on that department over the past year or two?
Well, I will say too that revisionist history is always something I try to shy away from. So although I would agree with you that I wish we would have hired somebody like Kristen earlier in our company's kind of founding, I think everything kind of happens on the timeline that it's supposed to happen. We were wanting to be so involved in the business so that when we eventually brought somebody on, that we would know we were able to troubleshoot and do everything. So I think that yes, we should have brought her on earlier. She wouldn't have been available. We may have been in a whole different situation. But also, like, there was, like you said on your little webinar, it was a little bit of a control issue. We wanted to make sure we had our hands on everything, which, probably net negative, but we did fine throughout that time. So, what is it? It is the constant battle of sales. That is something that everybody fights. And even the biggest swinging guys in the industry have to deal with. You I start off in a slow period, you prospect your minds out. You literally do everything that you can, reaching clients, warm leads, cold calling, reaching out to people on LinkedIn, social media platforms to try and generate that action and that activity. And then you get the action and activity, and you feel like you have spent your entire day dealing with the ebbs and flows of deal flow and loan submissions and processing and trying to make sure you're nudging people along with conditions that need to get things ready for clear to close and so on and so forth. But as a result, prospecting sometimes takes a little bit of a back seat there. So I would say, like, from our standpoint, you and I talk about this ad nauseum. We need to just prospect all the time. And so I think in the last 12 months, specifically, what I have tried, and I'll just, full kind of disclosure here on that front, what I tried to do was get involved with, whether it's networking organizations, real estate organizations, nonprofit organizations. I tried to fill my time with being out in events that I truly enjoy being at and staying in front of different groups of people, and with an idea that that would naturally result in good relationships, referral sources for us to send people to if we couldn't service them, kind of expanding our network, right? Um, what I've kind of realized is that I didn't, I think I leaned too heavily into that, right? So what I thought would happen is just that natural expansion of networking would result in natural prospecting. And, I went too heavy on those kind of things. And so now it becomes like industry specific. Now it becomes more cold outreach with some of the AI platform that we, have been enrolled with. It's getting systems in place so that when we eventually bring a salesperson on, which is ideally the goal that we will have here very soon, um, we have the information and the data that we can have somebody constantly hammering that stuff, because we have a full client roll of people that we do business with. We need to make sure we're staying in front of those people. That is like number one on the list for anybody in sales. Make sure your current client base is heard. Doesn't mean they're happy all the time. Doesn't mean they're always doing successful deals. Doesn't mean everything is peachy and rosy. You need to be there to talk to them to make sure that they know that you, as their service provider, are currently and constantly always trying to figure out how we can assist you going forward. Because as hard as it is to get somebody into your client role, it's even harder to lose them. Not to say it's perfect. There's turnover all the time. But once you get to a certain point where you have enough clients, that type of prospecting takes up a lot of your time. And so when we bring in new meat or a greenback or whatever you want to call them, him or her in that position, the goal is to have the systems and information available for them to try to successfully build a book of business. And so we, as control freaks as we are, how long it took us to be able to get somebody of quality for like Kristen in the mix, um, we want to go through those steps too. So that when somebody comes in, it's like, hey, here's the information. These are the steps that we did. Here are the results that we got. You are relatively new, so you may not have that quite conversion ratio, but here's what you got to do. These are the folks you need to be in front of and speak. These are the programs that they want to hear about, and so on and so forth. So I would say, from a lacking perspective, diversification is key, even on prospecting. Don't rely on one thing. Constantly try new things. And if you have implemented a strategy that you can literally look back on the last 12 months and say, maybe that wasn't as successful as I was hoping it would be. Hey, that's okay. You live, you learn, you continue to try new things, and you try to kind of fine tune the system. So I would say that I relied too much on trying to be out in front of crowds that were primary channels of business for our company. And they are great organizations. They are quality people. They are a lot of fun to be at. That's for sure. But just try to dial it up a little bit to focus a little bit more on industry specific types of things. And I think that would be a really good goal for us to set moving forward in 2026, which is hard to believe we're in 2026. So yeah, that's kind of what we're lacking is more industry specific, straight to the point type of stuff, and then follow up, follow up, follow up, baby.
Yeah, it's and that's where the challenge is. You and I could have a great conversation today, but you may not be sourcing a deal or taking one down for another 9 months. I can't call you every other week and say, Corey, where's the deal at? You're going to stop taking my calls. So it's how do we stay in front of investors or potential clients such as yourself over this period of time to when we finally get a hold of them, they don't say, "Oh, I forgot about you. I could have
Oh
used you
man.
about 90 days ago." And it's like that happens all the time, and it's time. It's like, all right, what is the most efficient use of our time? We could get a bot to be following up with people, but how can be efficient? But then our clients are like, "Hey, why don't you just call me?" My biggest pet peeve is when I someone messages me on LinkedIn to add me, and they write a little comment. I was like, let's see if this is a bot or not. So I just won't respond. I'll wait 24 hours, and then you start getting into the automated campaign on that, and then I'll respond. Like, yeah, let's set up a call, and then it's crickets for like 2 weeks, or even worse, we get a response, and it's their assistant that is having a conversation with you, and not them. That is an immediate call I do not take on that side of things. It's like, I thought I was talking to Steve the other time, and it's actually Anita. Like, hi, Anita. You should have just said it was Anita from the beginning, and I would have taken the call. It's it. I don't know. It's tough. It's moving fast. The AI moving fast. Great opportunities out there to implement in your systems, and it's my issue is potentially getting something into our software that goes rogue because it's
Right.
all so new and in infancy, and it's the IT risk that scares me behind some of these softwares, um, out there, and they're super powerful.
Well, I mean, you said something that I thought was like a perfect, I don't want to say a catchphrase, but it was like a perfect synopsis of this issue when you were on the webinar with Matt from Verivest this morning. It was very interesting the way you phrased it. You said you can automate yourself out of business very quickly. And that to me is probably, we're in a, even more so now with all of the abilities of AI and lead generation and follow up and all of this kind of stuff. You're going to set yourself apart with personal touch because it's going to be refreshing to hear from the person that actually is reaching out to you. My LinkedIn inbox, I've gotten to a point where the minute you add somebody, the message chimes. And I could be sitting in bed at 10:45 going, okay, let me get caught up. It's like, there's no way this person is actually sending me a message. Ultimately, if you have reached out to me on
That's a
LinkedIn,
45-minute email you just shot out in
dude,
15 seconds. It's spectacular.
if anybody watches these things, I don't know if they do. We like doing this kind of for just kind of getting things
All
out. But if
12 of
anybody,
them.
yeah, yeah, if any of the 12 people watching this is sending me a message on LinkedIn, my information is everywhere on our website, on LinkedIn. Send me an email or give me a call because I have stopped replying to LinkedIn messages unless it's a familiar name and it's got a very specific type of style that I can look at and go, oh, so and so wants to actually have a conversation because it's kind of ridiculous. It's just, it's not what is intended. And I just get very turned off by the automation. I don't think that that's a healthy way. And we sat down years ago with a buddy that we knew from college and we were talking about direct mailers. And ultimately, I look at this in a very similar way. Just because I don't like it doesn't mean it doesn't work. So that's not what I'm saying. But it is a preference of mine that I would rather have a conversation with somebody um, in a more genuine fashion. And maybe I'm not the target audience then. So that's okay though.
Shaking hands and kissing babies. I mean, at the end of the day, we're in the people business.
Yeah.
Whether you're in the loan business, you are in the car industry, if you're an accountant, you're believe it or not, you're in the people business. So I think the human interaction is important. It's not necessarily required on every transaction, but they want to hear a voice. They want to hear
Yeah.
that you're real. But my ultimate goal, utilizing LinkedIn, I do everything in my power to drive a potential contact to have an in-person meeting, one way or the other. If you don't want to golf, let's go get coffee. If you don't like coffee, let's go drink beer. If you don't like beer, let's drink water. If you don't like water, like, can't be friends. Like, you have to have water. So it just my point is you got to find my point is you just have to find a way to relate to somebody, meet them in person, to where now you have some common interests, to where when it comes to the follow-up, I'm not just asking about the deals. Maybe I'm inviting you to a charity golf tournament, or we're gonna go surfing, a few people from the industry,
Yeah.
or just hit a bucket of balls, or, here's a charity event that I think might interest you, or shit, come meet some of my competitors. Like, I I don't care, but it's just I think having that in person is important. It's a good integrity check, and, just giving yourself the opportunity to ask somebody tough questions in person, but also giving them the opportunity to grill you in person if they choose to. And you can find out a lot about somebody over a quick 30-minute chat in person. Takes time, but it's like, all right, you're looking at the targets and how you're allocating your time, to your point, going to too many different types of associations or networking groups where it's kind of trying to cast a wide net, or do I reallocate my time to get more industry targeted and focused on not necessarily the big players, but maybe some of the mom and pop type style offices that um, might be more receptive to meeting on short notice, and you hammer them, visit their office, educate, connect. But it all takes time, and I think that has been the biggest challenge for me. It's, yeah, we want to do more commercial deals. It's fabulous. Where do you start? And it's like, shit, from 0. And it takes time, and then you start building rapport, then you get busy with deal flow, then there's a new legislative thing coming down the pipe, like, it just rechanges how we have to look at certain things, and before I know it, look, it's been 4 months since we jumped on camera here,
My
just to kind of
God.
update everyone and to have a conversation. It moves quickly. Or, hey, we're gonna be doing just monthly updates on Mailchimp. We're good for, 6 months, and then then we get busy. But it's because of all the little things we were doing leading up to that allowed for the visibility to be there and the non-sales sales approach,
Right.
and then it kind of falls off. And someone listening is probably say, "Well, there's an AI bot for that." I'm sure there is, but we want a human. So that's probably some sort of hybrid uh, blend there going forward.
Well, when Elon releases some
That's my
robots,
rant. That
yeah. Well, when Elon gets some robots going, maybe we can get somebody in that's got a personality, and we'll dress it all up and all of that kind of stuff. But I want to ask you a question before we wrap
the
this
crazy
up.
thing is,
Go-
yeah. But real quick, we are like, you ever see the movie I, Robot with Will Smith? We are
Oh,
literally there. Like,
yeah.
it's.
I mean,
I'm gonna go rewatch that movie and get scared shitless.
um, so I was going to ask, we're in a time in which if you listen to the news, and I was having a conversation earlier today with a mortgage buddy of mine where he's telling his salespeople like, "Oh, I think we're in a pretty solid market. It's not necessarily what it was in COVID, but if your borrowers are listening to the news, foreclosures are up X amount of percentages and all of this kind of stuff." The conversation kind of revolved around the fact that like we tend to hear news that is bad, but if foreclosures are up even 100% from recent history, that's not a lot of foreclosures, right? I mean, I'm using 100% facetiously, but what I'm saying is your foreclosure activity is up, but it's up from historic lows. We're only hearing the negative. But from an investor perspective, when you work with our investors, what is the mood and kind of the attitude and the feeling or the questions that you're getting now that may have been a little bit different this time last year or 18 months ago, right? Because we are kind of seeing a transition into a slightly different market at this point in time, if we haven't already transitioned into it. I got to imagine that investors have um, had a little bit of a different perspective, right? Or at least some different concerns on that front.
So, what a question. We're gonna run out of time here. So each investor is a little different, but I would say for the most part, our investors are go, go, go. But that goes to all the conversations and sharing of data that I have with them on a daily basis. 12 to 18 months ago, um, interest rates were higher across the board. The institutional money had repriced to higher interest rates, so we were able to achieve higher returns for our investors without increasing leverage. I had let them know that that's not going to be like this forever. We could expect them to start ticking up their leverage again and bring down pricing over the next 12 months or so, and we've seen that. Educating them on different types of deals we want to do to mitigate their risk. If I'm going to be doing a 95% loan to cost loan at 75% ARV and price it at 8.99% interest only, one, we're not going to do that. But two, why would I do that when I could do a 60 to 65% loan to purchase price loan on a 35 unit multifamily at 899? We're going units all day.
Yeah.
And it's the cash. The cash is king coming in on that. Um, Educating them on the risk between cash out refis and purchase loans. What could go wrong with that? There are far Cash out refis referred over through a mortgage broker are probably the riskiest deals any lender could look at. Not because the mortgage broker is shady, but just because we are putting reliance on their conversations from the borrower. So we need to speak to the borrower. But use of funds, where is that money going to? Is it truly going to expand their portfolio? Or is there some bones buried somewhere that they're trying to patch up on another part of their portfolio? And we don't do too many cash out refis. But when
Right.
we do, it's when did you buy it? How long have you owned it? What's it generating? What's your basis in the property? Where are the funds going? You probably hate the conditions I send out, but sometimes they're a little bit different because the scenario is slightly different. Or maybe I had a conversation with a lender elsewhere that just got run through the ringer on some sort of fraud. So it's like, hey, we're going to add this additional request to mitigate that. Doing bank VODs helps mitigate that. But in talking to our investors about the market as a whole, I said it's going to be trading flat. I don't see it crashing. I don't see it running through the roof. Rent control restrictive areas. We've been talking to our investors. Those have been a concern of mine, and you're seeing LA soften like crazy. And they just get more and more restrictive with their rent control. You look at price per unit, price per door, cap rates across the board in LA 5 years ago, coming right out of COVID versus now, and rent control has really accelerated and picked up steam. They're trading south, and it's now if you're pushing too high a leverage on a value add, there's risk there. We haven't really chased the shiny product or toy out there, the ADU play. I'm highly skeptical of that. I think if you're a buy and hold long-term investor, the ADU play is a thing of beauty for you. But if you're a value add investor that's looking to acquire, get plans, permits approved, break ground, and have that property sold to another investor within 24 months, good fucking luck. Like I hope like within 12 to 18 months you have plans and permits approved. And then I'll throw a caveat on there. There are some really great investors and developers that are doing extremely well in ADUs. They are in the minority. I have said this many times. The ADU play is going to bury more investors and create successful ones. Now, explaining that to our investors, right? Because some of them don't invest with just us. They go with
Right.
other lenders, or they put money into funds to try and just keep that capital working. A lot of these other lenders are pretty bullish on ground up construction and even the ADU play. But hey, at 18 to 24 months, if no ADUs are started and you're banking on that added value from those ADUs, you're in a tough spot as a lender, let alone, a borrower. So it's kind of sharing that, but we lose a lot of deals because of it. I mean, because we're not going to be pushing them. And we have some investors that would be willing to do it.
Yeah.
But it's just I think we look at those refis in 18 to 24 months and say, "Hey, I'm glad we didn't push it on that." But overall sentiment with our investors, they like the approach. They can't get their money out fast enough. And again, it goes to the types of deals we're doing. We are not doing ground up construction. We are not putting a ton of value on ADUs. We will finance the ADUs, but our more sophisticated borrowers understand that, hey, I need to close with some sort of reasonable leverage on my bridge versus closing with construction financing in place because now I'm paying for a construction loan that I'm not going to be able to touch probably during the term of this
Right.
initial loan.
Yeah.
So it's a different type of borrower we're also targeting as well, I would say, which helps with our investors and then the performance, and also them not feeling like they're getting sold. Like I've pulled deals from investors because they asked me, "What, Brad? Why would you do this deal, and why should I do it, Mister and Mrs. Investor?" I'll explain to you our underwrite and why I feel comfortable with this structure, but you no longer get the opportunity to fund this loan. And I have done that a few times. And it's not to say, hey, F you. It's like, no, it's because they're seeing something that's overly risky and making them uncomfortable. And it's not on me to make them feel comfortable with
Right.
with the investment versus saying, hey, you're uncomfortable. Okay, now let me sell you on why you're wrong.
Yeah.
I don't like that because if that deal goes sideways, well, Brad, you told me X, Y, Z. Well, yeah, that's what made me comfortable. But no, here's underwrite, here's a borrower's track record, here's credit, here's liquidity. Uh, here's where I see some of the risks. Here's where how we're mitigating it. Mr. Mrs. Investor, now you get to track this one and see how it goes full cycle, and I'll update you. You don't get to fund it, but I'll show you in 6 months. I've done that a few times, and I
Yeah.
share with the investor in 6 to 7 months. Here's what happened. Here was where we thought it was going to sell for. It actually sold for greater. Here was an underwrite on the front end that we discussed, but it's continuously educating them and sharing with them post closing on deals, and then being a resource. I want our investors to call us when they have shit hitting the fan on another transaction. I can't advise them. I'm not their advisor, but I could tell them how I would look at it and who I would get. I could connect them with attorneys or service providers that could help them navigate those choppy waters. I will share with this. There are one thing I have been saying the last 12 to 18 months. And money hasn't been the issue. Quality of deal has been the issue. You have a lot of debt funds that have popped up and raised a shit ton of capital, which is great. They are offering good products, and their portfolio has drifted into more construction type deals versus what they were doing 12, 24 months ago. So the risk of that portfolio has completely changed. And let's just say returns are holding constant. You have more risk for the same returns. A lot of times rates are coming down. So you're taking on more risk for less return. And some of these construction deals, I mean, it's very hard to be a developer for longer than 10 years. Let's just say that.
Right.
It's hard to be a developer for longer than 5 years. Very few can say they've been successful at it. Very few. So the amounts of volume going into ground up construction right now, it's some guys could weather that risk. The debt funds, some can weather it, but they're not GCs. They don't have construction teams in place. And it's going to be interesting when some of these start going through foreclosure, which they are. I was chatting with one of our investors that has exposure in a few different funds to keep the capital working. They just received a 9% write down on their portfolio with a debt fund just because they have increase in foreclosures on a lot of construction loans. Fund is levered up. They have a lot of construction loans, which are also high leverage. Performance is not quite there, so they're writing down the value. Um, so that is happening. I think you're going to see more of it, and I think you're going to see more investors potentially pull from these high leverage construction debt funds and go back into your traditional trust deed, or I call it a boring debt fund. Just give me six
Well,
percent,
yeah. I mean,
7%. Like it doesn't need
yeah.
to be sexy.
I think the interesting thing about that too is,
Sorry, that was a big rant, but that's kind
no,
of how
that's all right.
what we've been going through.
I think the interesting part about that is, the operators of the debt funds that are kind of expanding their product lines. Investors probably put a lot of trust and kind of confidence in them because they've built their fund over so many years with so much success, so on and so forth. I would just, you know, caution to the wind. And who am I? Again, not the smartest guy even on this little webinar, but or this podcast or interview or talk, whatever you want to call it. Um, doesn't
You
necessarily
could be the
past
second
perform.
smartest guy. It's still pretty good.
Yeah, I mean, listen, past performance on a certain product type doesn't guarantee future performance and future success on different. So just because you can underwrite and navigate and have a successful fund that maybe, fix and flip and rental properties and so on and so forth doesn't automatically transfer, right? And so I think there'll be some learning curves there. But anyways, I mean, I think that was all really good insight. And I think we only have a sample size of 4 now, but we have out our coverage on time for this one. And maybe if we don't take 4 months to do the next one, we'll keep it to 30, 35, 40 minutes next time around. But I thought it was great catching up. And, we'll try to get another one on the docket at the beginning
Likewise,
of the
man.
year.
And on a
And
positive note, I didn't realize that the Bears had 9 wins till I saw the highlights of their game this weekend. So,
is it 9 or is it
go
8?
Bears.
I don't know. But Yeah, go Bears. I
I
mean,
think it might be. I think it might be 9, but they did
yeah.
lose, right?
Yeah, thanks. Yes, they did lose, and it is odd being a Bears fan because it feels like they actually are good, and I haven't had too many experiences with that my entire life. So bear down and let's rock and roll.
All right, shake and bake.
Shake and bake, man. Talk to you later.